Hi guys, so let's take a look at policy responses when it comes to inflation. Now, it's interesting to bear in mind here that, of course, with an inflation level, CPI target level of 2%, the Bank of England and the Monetary Policy Committee at the Bank of England have to try to attain that 2% target in the medium term for the economy. That's not to say that they are terribly successful in doing so, but nevertheless that is their aim. Okay, that's their stated aim. So the number one way that they will actually try to target this level of inflation is through interest rate changes. Changing the interest rate, of course, will influence the cost of borrowing and the reward for saving. That in turn, when it comes to incentivising saving in the case of an interest rate rise, will take money out of the economy. So the actual available money supply within the economy will diminish as a direct result of that. Okay, now of course it will also influence aggregate demand. It will influence aggregate demand in terms of consumption and investment. If you cut interest rates, then you're actually encouraging more consumption and more investment to be undertaken. Okay. Likewise, if you increase interest rates, then it's going to have the opposite effect. Another interesting impact, of course, when it comes to interest rates is the effect on the exchange rate. This is something that really strong economists will get to know very well throughout the economics course, that if you actually increase the interest rate, the exchange rate is likely to appreciate. Now, if the exchange rate appreciates, then you have that acronym SPICED: strong pound, imports cheap, exports dear. Now, in doing so, an appreciation of the exchange rate will actually reduce the cost push pressures on the economy because, of course, imports are becoming cheaper. So it may mean that input prices become cheaper for many businesses. Okay, so that's another interesting point when it comes to interest rates. So interest rates are the go-to policy that's used when it comes to inflation. Okay, now there's also the use of the money supply and quantitative easing. Okay, so quantitative easing has been used after the global financial crisis in 2008. We had £375 billion worth of money created, and that was, of course, in order to go alongside the expansionary monetary policy where interest rates went down as low as 0.5%, and after the Brexit vote, lower than that. Okay, but this was used to help reinflate the actual economy at that time because there were severe concerns that there could be some deflationary pressures on the way, and of course deflation carries some significant downsides. Okay, so use of the money supply, how can you do this? Well, it could just be that you limit the actual printing of currency, that you don't introduce new currency to the market, or perhaps it may be through that quantitative easing, but there's other methods as well. So for instance, when it comes to the reserve requirement holdings of banks, if you actually say to banks, as the Monetary Policy Committee at the Bank of England can do, we want you to hold more deposits for every loan that you make, then again you are actually restricting the actual money supply in the economy, and this can limit those demand pull pressures once again. Okay, so it's interesting just to note then, when it comes to interest rates, yes, because of that exchange rate appreciation, that can limit cost push pressures. Generally speaking though, it's going to have demand pull as the major influence. Okay. Now when we come to fiscal policies, of course here we're focusing on changes in government spending. So the changes in government spending, again, it depends where the economy is in the state of the economic cycle as to whether they want to actually increase government spending or decrease it. Decrease it during a boom so that you don't generate too much aggregate demand and too much demand pull inflation, and vice versa really for a recession or a slump period. Okay, further to that, you can also use changes in direct taxation on people's direct income earnings. So that could be changed in national insurance or income tax, or for companies on corporation tax. Now, that, of course, can influence individuals' disposable incomes, as well as companies' retained profits. So the amount of money that they actually have to reinvest in their business and generate more investment. Okay. Further to that, we've got this point regarding indirect taxation. Now, changing indirect taxation, of course, can cause a short-term increase in inflation. So if VAT was to be increased, or indirect taxation on particular goods, be it perhaps on alcohol, then that would cause an initial price rise in those goods, but that would not last, of course, in the longer term. Okay, so again, really, you're really tackling the demand pull factors once again, really, when it comes to fiscal policy. Finally, we've got the supply side policies here. Now, the supply side policies, they tend to be very costly and take a long time to actually come through to have a real impact on the economy. So anything that helps you to improve productivity, competitiveness and innovation can be deemed to be a supply side policy. Okay, we mentioned, for instance, change in direct taxation on company profits. That can encourage companies to reinvest more profits and undertake more research and development into developing new products and services and that innovation element. Okay. These are very, very long term though, so really when it comes to the long term perspective on the economy, these may well be used, but in the shorter term you're far more likely to see changes in the interest rate, even though there will be a bit of a time lag between that interest rate change and when it really does have an effect. As a tracker rate mortgage holder, for instance, it takes at least a month for the actual interest rate change to actually bear an impact upon the costs of our mortgage. Okay, all right guys, I hope that's useful for you there. We'll look at the evaluation of these in our next lesson there. Okay, thanks.